Purchasing a home is a decision that will impact your financial situation for the next 15 to 30 years. It's important to calculate your monthly income and expenses carefully to avoid winding up with a mortgage loan you can't pay in the long run. But don't worry, we're here. Do you want to figure out whether you're capable enough to get a home for yourself or your family? Well, we're here today to tell you just that. And if you don't qualify, make sure to watch the complete video to know how you can also jump on the same train. Watch this video to fully understand how much house you can afford. How to calculate your home affordability. The easiest way is to enter your information into an affordability calculator. You will need your gross monthly income and monthly debts, as well as desired monthly payment amount. Your down payment amount, state, credit rating, and home loan type information will be required. Once you've input all the information according to the method you choose, the calculator will let you know the maximum amount you can pay for a house, as well as your estimated monthly payment. Understand the 28/36 rule. Lenders may determine your ability to afford a new home by using the 28/36 rule. This rule states that housing expenses should be no more than 28% of your total pre-tax income. This includes your monthly principal and mortgage interest rate, home insurance, annual property taxes, and private mortgage insurance payments, PMI. Total debt should not exceed 36% of your total pre-tax income. This includes the housing expenses mentioned above, as well as credit cards, car loans, personal loans, and student loans, so long as these monthly debt payments are expected to continue for 10 months or more. This does not include other monthly expenses such as groceries, gas, or your current rent payments. Check your credit score. It's important that you request your credit report before you start the application process to find out your credit score. Borrowers with high credit scores will typically be offered the lowest interest rates, while those with low scores will be offered the most expensive rates. Calculate your debt-to-income ratio. The debt-to-income ratio, or DTI, compares how much you owe to how much you earn, specifically your monthly debt versus your monthly pre-tax household income. It's an important metric that lenders use to determine how much you can borrow, or if you can borrow at all. A high DTI indicates that your debt is high relative to your income, and vice versa. The higher your DTI, the harder it will be to get a mortgage. Lenders prefer borrowers with a DTI of 36% or less, and will offer them better interest rates on their mortgage. Ways to improve your house affordability. There are several options to consider. Some methods must be undertaken over time, whereas others will immediately impact your mortgage application. 1. Lower your DTI. Lowering your DTI by paying off as much debt as possible is a good option if your DTI is too high to get pre-qualified for a reasonable interest rate, or to qualify at all. An optimal DTI is 36% or below, including possible housing costs, but excluding current rent payments, if any. 2. Raise your credit score. First, it's important to check your credit report from all three bureaus, Experian, TransUnion, and Equifax, for inaccuracies. If there are mistakes in your credit history, you can file a dispute with the credit agencies. They are legally required to address any inaccuracies promptly. Pay your outstanding debt on time every month and, if possible, reduce your overall credit card debt. The higher your credit score, the lower your interest rate. 3. Consider applying to federal loans. The type of mortgage you're requesting will help determine a lender's flexibility in evaluating your loan application. Loans insured by the federal government, such as FHA loans, VA loans, and USDA loans, all have certain benefits that may help you afford the home you want. FHA loans. FHA loans are insured by the Federal Housing Administration. This means that banks get paid even if you default on your mortgage, and so are likely to be more flexible with their credit and down payment requirements. Note that, in order to qualify for an FHA loan, the borrower must intend to use the house as a primary residence and live in it within 2 months after closing. VA loans. Borrowers who have served or have certain military connections may qualify for a VA loan. VA loans are more lenient than conventional and even than FHA loans. They are backed by the Department of Veterans Affairs and typically don't require a down payment. Qualifications vary depending on the period and amount of time you served. USDA loans. USDA loans are backed by the U.S. Department of Agriculture and offer certain benefits that conventional loans don't. They're designed to help finance homes in eligible rural areas. The desired property must fall within specific geographical areas, generally outside the limits of major metropolitan centers. It must also be a primary residence with a relatively low cost. If you are eligible, USDA loans have many benefits, including allowing you to build, rehabilitate, improve, or relocate a dwelling as your primary residence to your new location. That was all from us today. Did you find this video informative? Comment below about more things you want to learn about. Don't forget to subscribe.